Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Renick. Day 2 of some selling here. We do have some action down at Cboe, a lively session with stocks trying to make a little bit of progress over the last hour, but not getting too far. S&P 500, well, we are making a little bit of progress. You're above 69 now. Pretty good little last 10 minutes there. As I was making that tick-tock, we continue to push higher. Intraday chart not looking terrible at this point. Here it is, S&P climbing. Certainly had worse moves off of all-time highs. But there's a little drama, no question about it, when you have some of the big themes like AI leaders getting blasted, AMD down double digits post-earnings, obviously a pretty big deal. The one that I'm mostly watching, of course, as always, I think the easiest thing to look at is NVIDIA. The reason for why is because not only was it really the kickstart for this entire theme of AI, but it's been range bound now, and you can see it $180, a key level. But there's a more important level, and that's 170. Here it is on the chart, the dash red line. This has not broken for NVIDIA since July 2025. So that's a range that you want to hold. If NVIDIA breaks down further, then maybe that's when I consider flashing the risk radar for stocks to red, but it's still yellow for now. Red for Bitcoin, though Bitcoin catching a little bit of a bid intraday. Strategy just getting annihilated still. Now the dollar, which has been red, obviously has reversed on me, but when we think about the macro dollar and bonds, I think there's a very interesting story developing where I do have more conviction on the bond red light than I necessarily do for the dollar. Reason for why is because you're just not catching any bid into bonds, even with risk off. Here's the chart for the TLT, down and to the right, lower highs, lower lows. Economic data also coming in pretty solid over the last couple sessions. ISM services above 50, hitting right where we expect, but don't forget that ISM manufacturing also actually hit above 52. So this is a number that generally, we can rely on for the services side to be strong, but not so much manufacturing. So a pretty important message that resonates with really the main theme that I put forward alongside Steve Sosnick from Interactive Brokers as one of the main risks for the year, which was that bonds and yields could blow out if you politicize the Fed in an economy that doesn't need rate cuts, and we just throw them on there anyway. So if bonds aren't catching a bid when stocks are getting hit, Bitcoin's getting destroyed, that tells you that there's not much appetite for bonds in general, which means if we stabilize, I think you probably look for yields to move higher. So that's where I think the highest conviction trade that I've got right now, personally, as far as the risk radar goes, is the red light on bonds. But gold, don't sleep on it either. After a serious shake and bake move for gold and silver over the last few sessions, people just came right back and are holding on for the ride. So very impressive. Gold hanging in today, doing what it's supposed to do, and SLV also with a red candle, but still up almost 3%. And you have higher highs and higher lows still on the chart. Obviously, it's going to take silver a big move to make those higher highs above 110, but the higher lows are very much intact. The dollar, I might have to revisit the thesis on that if yields are going to move higher, but generally the long-term trend for the dollar has still been one that's been downward sloping. So the important stuff, I think, going forward for the rest of the week is seeing if the S&P 500 can regain, obviously, any of the ground lost between 7,000 and 6,900. But it's only 100 points, so I think we continue to call this spasms rather than real selling or dumping of risk assets overall. So with that said, let's bring in Mr. Brent Kochuba from SpotGamma, who's been talking about, of course, the kind of maybe need arguably for spasms, Brent, as we kind of get the index volatility in line with some of the single stock vol. Is that still the best way to describe this from a volatility standpoint?
Yeah, there's a lot of interesting stuff happening today, Oliver. You mentioned AMD obviously getting kneecapped and some of these software stocks, but do you know what is leading the market higher today, Oliver?
Well, I was watching regional banks, but there's some other stuff that's working pretty well too in rotation.
4.5%. XHB.
ITB, yep.
The Dow.
XHB, I was looking at ITB. Yep, a leader in the
The
market.
Dow is up on the day. The Dow is, your dad is probably happy, I'm guessing.
You got DuPont up there. And by the way, a few tech winners as well. You got Supermicro doing all right. But to your point, yeah, I think that a lot of this we can call a rotation to a large extent, right? Here's the S&P watch list. Go ahead, Brent.
Yeah, well, Uber also getting down about 5% today. You mentioned the carnage in AMD, but there's these other things. So it is hard to look at this as anything other than a rotation at the moment. And again, to your point on spasms, this is pretty nasty when we kind of open and just have this sort of liquidity flush. But here we go. The afternoon bid just seems to come in as it has like every day for the last week now, where we've dropped 1.5% roughly intraday, and then we rally on back. And so in this case, you have to look at that rotation because of some of these kind of rate linked stuff is just doing well. And the fear here, as we kind of wrote about this morning, is that one of these spasms catches, right? And you don't get that kind of reflexive dip buying. And so that is indeed what makes it so hard to own stocks with the S&P, roughly around, 6,900, because it just feels like at any moment we kind of catch that, downdraft, and that makes it a little bit tricky. And then on the point of the correlation is higher if you look at that CBO Core 1M, which we've been, kind of beating to death here. But it's not at this level where you go, okay, it's totally, everything is normalized, right? 11 on that, and again, this is just an index, but 11 on that is a far cry from 17 to 20, which would normally correspond with the VIX kind of being 20 to 25, right? And so there hasn't been this vol spike and this sticky vol move yet, just as again, the equity market keeps rebounding. So we're not in this spot yet where you can go, hey, I want to sell vol because it just looks so delicious, and we're not at this other side of the equation where it's like it's easy to kind of put the risk on. So digestion, again, I think is just sort of the name of this game, and we'll kind of wait for some things to clear up. I think the Google signal will be really big today. I think a lot of people will be looking at kind of the guidance out of there, and I'd have to imagine that a lot of software-related questions to come up, right? I mean, Google's seen as the AI leader at this moment, and so
That's correct.
What does this mean in terms of is software really dead? And on the point of software, Oliver, we were talking about gold, at implied vols of 100, and that was kind of getting crazy. Software is doing the same thing, just to the downside now, right? Like, I don't know how you start to price in, okay, all software is being exterminated. I mean, if you own Salesforce, are you going to kick it out because you can clodbot your way to a CRM? Like, probably not quite yet. So I think some of this stuff is just getting a little bit stretched to the downside, and we see that in IV ranks of 100 and things like that. So that trade largely seems sort of wiped out. But the interesting thing about this is software stocks are all going down, right? That's correlation of 100 in that sector. And so, again, it just kind of speaks to this sort of rotation. We're not getting this uniform stock off, like all stocks go down at the same time. So that correlation can't quite, I guess, repair itself is how I would call it. And then the equity vol, yes, VIX is elevated, but at the money implied vols are up about half to 1 vol point today in the S&P. That's real. It's not, it's not something you ignore, but it's not like doomsday. So there's a little bit of hedging going on. There's a little bit of a put skew lift in S&P, but this isn't sort of the situation where, people are buying longer dated puts hand over fist and we're just feeding into the downside. So the summary of all this is it seems like rotation. We're seeing some mild hedging in the on the index side, and ultimately, I think right now you got to consider this to be fairly healthy kind of consolidation, burning off of the overbought signal we had last week, and just sort of some renormalizing in line with what we were talking about yesterday.
Great assessment, and I love the way the conversation is flowing because it follows the market data, which is stock specific. What we're talking about, there's certain days where we come in and we talk about index level action, and I do want to get your thoughts on some of that, but the fact that this conversation begins on a stock specific level is so important because there's rotation going from sector to sector, but then within some sectors it is it's a very severe rotation. Look at Robinhood is one that I pointed out as well, which I think is actually very thematically connected as well, because last year when I was trying to think about how to describe everything that worked, there were so many different facets to it. I called it the everyday trade, because if you're using the AI stuff like I am, you're using it every day for your productivity, for your workflow, and then if you're investing in those companies, which you should be as well, investing in the market, you're doing that every day with businesses like Robinhood. And so all these things kind of unwinding to find new leaders is not something indicative of an economic-driven sell-off. It's something much more indicative of concentration, deconcentrating. Volatility is kind of getting in line with pricing that might make more sense, where things had been very extreme and askew, if you will. So Google, to your point, to summarize that point, is Google could be something where if it bombs, there is that still concentration in the index where this could become a problem if the big time leaders start falling off the edge too. Like Nvidia breaks through 170, I think that's a problem. If Google
Microsoft
cracks big time as the leader, as the everyday leader of Gemini, I mean, I'm using it on my phone nonstop, then I think maybe we have a different conversation tomorrow, which might be more index level based.
I agree with those points, Oliver. And on the point of Robinhood, you got the prediction markets, which are really catching fire. Right? I know Robinhood wants to launch theirs, but that's eating their lunch a little bit. The sports betting thing is a headwind. The crypto thing is kind of a headwind for them. So, there's a bunch of things here where the retail stock traders aren't thriving like they were. The crypto market's now in the rearview mirror, and there's a changing evolution here, right? And then on the software side, just go back that quickly. Google, Microsoft's getting, crushed, right? And so Google in the CapEx story, that still seems to be intact if you look at what Meta was talking about last week, et cetera. So, that kind of story is still there. And a 5% implied move is what we're looking at for Alphabet. But these semi stocks like an AMD, they were, the belle of the ball late last year, and then it switched to these memory names, right? And the SanDisks of the world. And that's where everyone suddenly is piling into. It's like that's the vector of attack. And so, this stuff is the stories are moving rapidly. And not to be the derivatives, pumper again here, but you get huge options flows move into all these things, and that just adds to the leverage of I think a lot of these moves. And so, is Robinhood being down 10%, warranted? Is the software stocks being down so much warranted? Well, when you look at the volumes in these things and the vols in these things, you're probably getting exacerbated returns, right? There's a vol that's being induced, I think, by some of the trading products that we see every day. And so what happens then is people go, oh my God, this is the end of software, because they see it's down 20% IGV in the month. But a lot of that is just the derivative sort of excess maybe pushing things a little bit, right? So you think the story is actually worse than maybe it is what I suspect. Kind of like in gold, right? Gold was pricing in the end of the known world if you looked at being up 20% in a month. Is that real? Maybe not when you have more options trading in silver than QQQ, right?
Exactly.
Kind of the point, right?
I'm pulling up your tape right now to put some perspective on this. Maybe I should put you in the bottom right there. There we go. Because this is what you're talking about, the whippiness. When you're a surfer, if you kind of live by the sword, die by the sword. This is the beauty of options, but also where you have to be. You have to understand what you're dealing with. Because when you're on the right side of the trade, it's beautiful, but the flows get very powerful and can flip the other way. And that's that's the give and take, right? It's like poker tournaments. If you win, you can get a big multiple of your money. But then you also can get that on the downside if you're not understanding kind of, when the tide might turn or the wave might turn the other way.
Yeah, that's totally right. And I think, too, if you're trying to assign kind of macro reasons to why the S&P has been pretty volatile here up and down the last few weeks, ultimately, we're only 1% from all-time high. 100 handles is basically 100, 1.5% at the moment. So, it's really not that big. And there's been great opportunities for this thing to just completely go from spasm to just sort of, liquidity cascade kind of thing. And, the bait hasn't been taken. So there is a rotation. The vol market is kind of sloppy. The options market is kind of, big. And I just think ultimately what that is we need some digestion. And, at some point there will be some new narrative out of this in terms of, here's the leading sector, right, that we can shift into. Mags are not providing that leadership at the moment. Maybe it turns into the reindustrialization of the of America or whatever, because some of those names like transports and things are starting to look pretty good, and the financials are maybe catching back up. So, there will be a new sector that I think emerges out of this, but there's not this sort of feeling of, hey, we're all going to roll out of here and roll into bonds at the moment, right? We're not seeing that rotation out of equities. We're just seeing a rotation amongst equities, and those are two, slightly different trades.
Correct. And again, you were obviously the options guru, but the macro connection is always appreciated, and it dovetails right into the risk radar I put up on the top. My highest conviction view right now is short bonds. Amid all this, I generally am still pretty confident in equities, but I'm confident in the gold chart because it hasn't broken down. People are still giving it a chance after a big sell-off that's kind of uncharacteristic of a precious metal to some extent. But it's bonds where I have the highest conviction, Brent, because to your point, there's stuff happening here that looks like it's not just kind of positioning-based rotation, but fundamentally based rotation. The Dow transport. Look at the chart. That's incredible.
I don't mean to laugh. Like, what the heck is going on over there?
KREs, ISM services, 53, whatever. Manufacturing, above 50. And we're going to put in a guy who's going to cut rates just because the big man's telling him to. So I don't see this as an economic expression of weakness. In fact, it could be the opposite. It could be the reheat and maybe the restoke of inflation. So that's why I think right now I don't worry about equities or short bonds.
I don't think that's wrong, Oliver. And what just sort of struck me for whatever reason when we were talking was, the knock on Bitcoin, which what made it the uninvestable asset historically has been volatility, right? It's too volatile to own, and it's still quite volatile. But like, what about gold and silver and how volatile they've been? And I mean, it's been unbelievable. And you look at that chart there, of the industrials. I think you're just looking at, and you're like, what is that move, right? So the volatility across assets just really seems, and not only just across sectors even, just really seems to be kind of picking up, and that doesn't seem to be subsiding. Of anything, that seems like a little bit of a new normal. So bonds right now look much more just sort of, they still seem to be lacking that volatility, I guess, as you look at that chart, and the vol there is cheap, ironically, on a relative basis. So I don't think that's a bad idea at all, a place to hide out where some of these other things just sort of normalize and get reset.
Yeah. That's a fair point, I think, on gold. By the way, I'm trying to do a better job monitoring our chat because it's been pretty lively, and sometimes I get a little buried into the conversation. Someone said, "Will be interesting when these flights to safety start landing in Haiti," which is kind of a funny way to talk about the risk of the precious metals. Not hating on gold bugs, says the real Axel, but seems irresponsible to have it. I wonder if that's the one and only Mr. Axel Merck, in which case I need to get him on the show. No, but he likes gold. So, look, I do think that the characteristic has changed for those precious metals, given the volatility and given the options flows, to your point. Like, if we go back to your tape, there's some pretty serious, numbers up here still for SLV, GLD, high ranking in the movers list. Gold, it seems, has dropped a little bit, but I feel like that could actually be a good thing to some extent, where maybe you don't want your precious metal, your safe haven, completely hijacked by speculators.
Yeah, I think that's true. And part of the problem with that is that, when these things go up 50 or 100% in a month or two, the point we made yesterday is like it broke on the upside, not really on the downside. And so if you're just a long-term investor not really paying attention, then maybe that doesn't matter all that much to you. But in some ways, a lot of this stuff becomes, I would argue, uninvestable for the average, certainly retail trader, when that vol is so high, right? Not just a sort of one direction, but you have the situation where stuff is doing nothing 1 minute, and then the next minute, it's the highest implied vol you've seen in a year. It's like out of nowhere, right? Because again, these vectors of attack just become so swift and so fast. And I think all this is also well and good. Well, generally speaking, these equities or these assets have been expressing upside price movement, right? The memory chips and gold and silver and things like that. But it can work the other way as well, right? So, you could start to end up in weird situations where that volatility, the downside, really causes some carnage. And then not only that, Oliver, people were talking about silver and its industrial use, right? And so what you've done basically is you end up with this derivatification, I can't even say that word, I just try to make it up, of these commodities that a lot of people depend on, right? So suddenly it's like, well, what's going on? People are buying SLV ETF options. So, some dude in Sri Lanka can't build his like manufacturing, his catalytic converters or whatever it is. You know what I mean? It's like these things just got kind of crazy. And that vol, I think is not all that healthy for, stuff outside the equity market, even though it's fun for us to talk about.
Yeah, no, I agree. Kind of a shortage side of the industrial, which, by the way, fits with the macro discussion, of the numbers coming in good and fairly hot for the economic data, the need for the the build out and the hard materials that go with it. Great context as always, Brent. Appreciate it very much. Thank you, sir. Brent Kochuba, SpotGamma. Excellent as always. I'm going to take a little 1 minute here where I set up Danny Kirsch, who's going to be right back with us from Piper Sandler. Thank you, Brent. And make sure you scan that free daily flow report at SpotGamma. Great stuff every day. All right, be right back in 60 seconds.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back. We got markets trying to grind back here, and we got Mr. Danny Kirsch joining us, head of options at Piper Sandler. S&P 500 closing in on 69 right now. Now we're off just 19 points on the day, Danny. It doesn't seem like bulls are ready to totally give up yet.
Yeah, I think what happened is that our firm was planning to do like a markets in crisis call at the close, and then once we announced we were going to do that,
Yeah, that was the
the market has been rallying since. So next time I'll shoot you a text and let you know
Yeah, please let
let
me
you know
know.
that the market's about to rally and you should be buying at the money calls in the S&P immediately.
Exactly. Well, hey, my thing right now is forget equities. I just feel like the high conviction trade is short bonds. You know, somebody in chat said bonds aren't telling me much right now. I kind of disagree. I think bonds are telling us a good bit. Nobody's buying them. Data just came in hot. What do you think?
Couldn't agree more. One of the things that we've been pitching and looking at and doing a lot of, we've done a lot of these put calendars to start the year where we were selling March and February and in April puts on TLT and LQD to buy June. And the thought is, like, I agree with you. I think rates are going higher, but you still need some sort of catalyst. And the catalyst we're looking for after April is twofold. One, you have Warsh's first, assuming he's confirmed, which I think is going to happen. I think that'll happen. So assuming he's confirmed, his first FOMC is in June. And one thing that he said, and maybe he's changed his mind over the last, I don't know, week. He doesn't like a big balance sheet for the Fed, and he's talked about shrinking the Fed balance sheet, which should put pressure on the long end. Beyond that, starting basically now, people are starting to file their tax returns, and the people who are filing early are the ones getting refunds, and those hit over the next few weeks. So you have, and the way the Big Beautiful Bill is set up is like people who are making between, it's like 70,000 and 400,000. That's who's going to see the largest refund. So, fairly well off part of the market and have a higher propensity to spend as well. If that money gets recirculated into the economy, especially if you think about higher ticketed items, trips, food, whatever it is, you might actually see an inflation pickup too. Around the same time, Warsh is about to become the Fed chairman, and could you imagine what the bond market does if he's unable to cut in June, which has been that's what we're all setting up for, is this June easing cycle. But if, let's say, inflation starts ticking up because of all these catalysts tied to tax refunds, you're seeing the data as well. Oil kind of going up. You're seeing this sort of commodity grab. I think China yesterday saying they need to stockpile copper. All of these things. You see materials ripping today. XLB taking out new highs. XLI taking out new highs.
Good point. I missed that XLB. Wow.
And that was a little bit of the China news today that they're going to buy a bunch of soybeans but the chems in general have been on fire. And I think it's like this national security issue where you need to vertically integrate your supply chain in order to not be relied on China, and that seems to be the U.S. policy. And it's not cheap to do it. It's just not cheap to do it. So at the same time, you also have Trump talking about raising the defense budget to $1.5 trillion. And what do you think goes into bombs?
Yeah.
Metal.
Metal.
Commodities.
Yeah.
So all of this ties into the same trade, and I just think it's I love being long volatility, especially in the bond market where it's super, super low. For the Warsh regime, because we don't know what it'll be. We know what we've read about him. Sounds like he wants to cut, and it sounds like he wants to shrink balance sheet. So that to me is a steepener, isn't it?
I think so. Yeah, I definitely think so. And I think that also the only thing that you would say, you said in there that I would disagree with, but I know you're saying it just kind of generally is he can't cut rates. if the economy's picking
No,
up.
you're right. You
But
can.
that's-
You can do whatever you want.
Exactly, he can't. 'Cause
Sorry,
he's getting put there. Yeah, he's getting put there to do the bidding. I thought that's the
Shouldn't
biggest-
is what I meant.
Correct, exactly. So that is just like gasoline on the fire. Now, and by the way, if we go technical on, I know you were talking about TLTs, but if we go technical on the 10-year for a moment, it looks like, 4.2 is my key level in the sand to the upside. We broke that. We came back, we tested a very classic test of, in this case, for yield, old resistance, new support. So it looks like the bond market's kind of already moved on. Like when we were at the lows of the day, there was no appetite for bonds. So I feel like this train might already be leaving the station.
Oh, I totally agree. Again, it's you're right. It's unable to rally. I think it's like we always try to cheapen things and like to have future ability to do something around our trades. That's why we like these calendars. But I think you're right. And the way that materials, the way that metals, the way that everything's behaving, this is an inflationary backdrop, like a growthy inflationary backdrop. So I don't know why you'd expect bonds to rally in that scenario. So I totally agree with you. And obviously you have like talks this Friday, hopefully with Iran and the U.S. and maybe things calm down there. Who knows? But in the meantime, like that maybe brings down oil prices, but everything else is kind of sort of out of control. And the way that the commodity complex is moving, it all points to higher rates. And that's the easier trade too, because the volatility is low. If you look like an XME that's totally broken out, the options aren't cheap. Like that, and gold options aren't cheap. Silver options aren't cheap. None of this is cheap anymore.
Yeah.
LQD puts are incredibly low. TLT puts are incredibly low.
GLD,
Actually, the IWM puts are.
SLV, oh my goodness, the implied vols for SLV across the entire chain are just through the absolute roof. Gold cools off a little bit after the weeklies, but it's still pretty elevated. To your point for TLT, it's calm waters, 10, 12 vols, so cheaper there. So just risk versus reward across the board, it seems like favors the bonds, and also just because to the point of some of the AI stuff, who knows when that unwind is due, right? Clearly it was due for AMD today. Even though I feel positively say about Google's Gemini, I could totally see this thing dropping 6-7%. So just because if we're going to rotate, eventually they're going to go to some of those higher liquidity spots, which they are. But that's not really a fundamental view of like
Google
Gemini not being a good app.
I feel like at this point, Google, the risk to the market is if Google says they're cutting capex. And people are okay selling these tech names to go buy other things. Like today, breadth is incredible. I think 350 S&P names are up. Certainly doesn't feel like that because the index is down, but it's really yes, 370 S&P names are up right now.
Also, sectors too. There's only 4 down.
Yeah.
Right. There's 7 up out of 11.
So I was looking yesterday, and the tech sector is 33% of the S&P, and the comm services is another 10%. So you've got 43% of the S&P is those, and then if you throw in XLY, which is Amazon, you're probably at you're almost at half the S&P is basically tech or tech related. Energy's 3%, materials are 2%. And you're seeing it today. It's like just getting a little bit of rotation. You have materials up 2.5%. It's just as this money gets reallocated, and our firm view is like this broadening out will continue, and perhaps tech will remain a source of funds. Maybe not semiconductors, but software. Clearly, that's the way it's behaving. It's clearly a source of funds. These areas that have underperformed for years, could see a pop. I mean, XLI not as much. Industrials have done really well, and we think industrials will continue to well. But materials is just a smaller subset of the S&P, and it doesn't take a lot of money recirculating there for these stocks to go.
I think energy gets interesting because there's a line that I've had on the crude chart for some time at about $65. God, I love when my lines work. Even I haven't even thought about this line in a while, and we just got rejected a couple times at 65 for crude. The downtrend line is under threat for WTI. My general thought for this one is always just like, when in doubt, sell crude on rallies. But if it gets through $65 meaningfully, who knows? I mean, just last year we had some wild movements in WTI between $80 and 66. So who's to tell what could happen if this joins in the commodity moves that we've seen in metals? Then people will really start talking inflation because crude wakes people up.
Yeah, absolutely. I mean, I think you could buy XLE as well. The volatility is just much lower as a way to play that. And these are names that are buying back stocks, and the chart looks incredible. I mean, another one that's like sort of breaking out and acting really well on a daily basis. And these companies have been have been very, very disciplined. And then you also have the potential upside, whatever happens with Venezuela, and like, if there's actually an ability to make money there, great. So I totally agree. And like industrials along, and we've been we've seen some dip buying in some of the tech areas and some of the software names, but for the most part, it seems like clients are just hesitant to sort of catch the falling knife and are more interested in the stuff that's trading well. And also, a lot of these areas, these cyclical sectors, are big beneficiaries of the big beautiful bill, and we should start seeing in earnings because of the being able to fully expense capex.
Yeah.
And you're seeing the funders of all this capex, the Googles, the Microsoft, they're underperforming, but the Caterpillars, the Deeres, they're getting paid and
That's a
that's
good
working.
point.
It's like the BDCs are though they're underperforming and they're getting
Look at
sold, but
Deere,
it is the right,
up
and it's the
4%.
companies that are like charging to build the data center and build, and then we know that there's a big push to build homes as well. These are the companies that'll, we think will continue to do well and also have the tax tailwind behind them of this full capex expending. And this
I
is, I
hope
mean, I think this is the plan, isn't it?
I hope that's exactly what I was just about to say. I love when we're kind of circling the same topic, which is I hope, by the way, that this trade works. I hope it's not a short-term thing. I hope that we build more houses to bring up supply and bring down prices. I hope that there is kind of this industrial revitalization of America that everybody thought was impossible. And I think a lot of these things make sense because they're connected to the real breakthrough technology that we're building. So I'm fine with all of this. And I've kind of been a doubter of that, where people are like, oh, we should be industrialized again, exporters. I'm like, I'm fine being the importer. Like I don't mind other people making all of our stuff and having a higher dollar to buy it. But
I think the
to
problem,
switch things around every now and then is okay.
yeah, I think the issue is the AI piece as it ties to defense. You have to be a leader in AI, and you have to have that tie into defense, and you have to be able to like that to me is like this bottleneck in the entire system is that if China wins the AI race, the U.S. is in trouble, and I think that's
Correct.
that,
Yeah.
and part of that is this rare earth stockpile. Part of this is the copper stockpile, and all of these things go into defense, and then it goes from there. And I think that's that 1.5 trillion dollar defense spending because it's all, we're in an arms race right now, and AI is tied to it, but it's like the industrial piece is defense.
Yeah, no, I agree with that. I think also that the pullback today, ITA, which was just at highs a month ago, is an interesting way to kind of maybe find a dip today that maybe is not fitting with some of the themes you're talking about to buy. Last point before I let you go, Danny, is
Sure.
you mentioned to us the bond trade. I always like to talk to you about my regional banks, KRE breaking out. Give me a thought on
Oh,
that, closing one here, because I mean that doesn't seem like the thing that happens if the economy is going to the gutter.
well, I think there was a takeout, right? WBS, I think, was taken out today or
Okay.
yesterday. So
Yeah,
that
yesterday.
was
Yep, good
yesterday. That
call.
was
Yep.
yesterday. So that getting taken out seemed to turn the tide, and people are like, okay, cool, we'll just stay long. And this has been, I think, an area that's been somewhat painful long, but now you're seeing it's like these fintech names are getting smoked in favor of the boring regionals. Like just think like Coinbase is down 23% year to date, and a name like PNC is up 15%. I
Well,
think that
Brian
like tells you
Armstrong
where
kind
the
of.
money's going out of and where it's going into. Robinhood's
Yep.
down 28%. Fifth Third is up 17. So I think like maybe that can continue because the market caps on a lot of these names are huge, and if you're going to see an M&A cycle, these larger regional banks I think are perhaps the beneficiaries, and that the deregulation side, which we've been talking about for over a year,
Tailwind too.
exactly.
Pretty good charts on the regional banks. Good eyes on WBS as well. Always on top of it. Danny Kirsch from the macro to the stock specifics. Appreciate that very much. Always a pleasure to have you on Chicago Future of Finance. Thank you, Danny.
Thanks for having me.
All right, you got it. When we come back, options with Hans. Mr. Albrecht joins us. He's been all over the short cloud trade. We'll see if he's interested in buying any of it back today. Coming up after the 2-minute buffer break.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back. We got Mr. Hans Albrecht joining us, CEO Options with Hans. What's up, Hans? You ready to buy some cloud stocks yet, or still beat them into the ground?
Well, cloud, look, I mean, we've been talking about how, you want to go to those less disruptible sorts of parts of the tech market, which is probably cloud is probably one of those where, you think of it as a highway. Do you want to own the highway or do you want to own the businesses along the side of the highway? Well, everybody's got to take that highway. That's the toll road. And that's the sort of toll booth type mentality that I think you've got to have right now, because disruption is happening very, very quickly, as we've seen in the software sector.
Yeah, it seems like the giants that once were now have to compete with the AI-driven startup potential. I do, though, feel like there's some floor for some of these giants to where they will have the ability to go and buy the best versions of the startups, but that's obviously a more cost-intensive kind of way to grow than being, the toll booth, right? Because some people are starting to just blow right through some of those tolls that CRM and others were charging.
Well, but that's the thing, right? You got these companies charging a whole bunch of money, and I understand people are arguing that, look, they've got fantastic cash flow, but we're not interested in a world of disruption, in one of the more disruptive type environments we've ever seen in markets. We're not so much interested in how a company did last year when they're facing certain existential type risks. Now, we know that markets overdo it to the upside, they overdo it to the downside. So at some point, we're going to see a little bit of sorting through the rubble, and that phoenix will rise from the ashes, at least some of the ones that probably have the strong relationships. It's very easy to say that, well, look, I can get Claudebot to basically, make a CRM type bit of software for me. I'm pretty sure that a lot of big companies aren't going to do that. They're not going to say that, Harold in the mailroom, he just came up with a nice agentic solution.
Might be his moment. Might be Harold's moment.
It might be Harold's moment. Look, Harold's looking, he's looking to get a promotion, so he's going to give it a go. But my feeling is the companies that are really ingrained in businesses are going to have a little bit of time to reinvent themselves. But having said that, I think this really is becoming more of a market. We see the binary aspect to this. Google wins everything, right? It's Google's world. We just live in it. And then software is all getting tossed out with the baby with the bathwater. So it's becoming very binary as people probably overreact in some ways. But I think that doesn't change the fact that you really want to understand structurally that this is a very, very big moment. We've talked about it a little bit before, Oliver. This, they've changed the name of it. It was Moltbot, it was Claudebot, now it's OpenClaude, something like that. And it's the ability to really get things done. It's astonishingly good. And you may have heard about, these agents have gone online, they've got their own social media network. Yeah. And there was one guy I was watching, his AI actually called him one morning.
I saw that.
Yeah, he called him. So listen, this stuff is getting crazy, and it's one step a little bit closer to the almost this like sentient sort of thing that people talk about when it comes to AI.
And I can't wait for the next Grand Theft Auto to come out. I want to see what how the AI is. So look, here's the point though, Hans. A 3-year weekly chart on IGV, for example. It looks like there's good support at $80. It looks like it's kind of cracked through a long-term trend line. Should we try and scoop up the general group after this bloodbath the last month?
I think we're getting there. Yeah, I think we're getting there. I've covered some of my long put spreads in Adobe. Actually, I rolled down the long leg of the put spread down to a lower strike. So it's effectively.
Shout out to you. You talked about that on our show. You talked about this short cloud trade, Adobe kind of being the worst offender, the most easily disrupted. So I believe you when you say you're taking some profits there. Do you leave some on, or do you try and rip it to the upside, or maybe let it simmer for a couple days?
I've let it. What I've done is I've kind of gotten cute with it. So I'm long a big put spread. So what I've done is I've rolled the long put down to a lower strike. So ineffective, I've basically flipped it over to a kind of credits trade, but now it still protects me a little bit if we keep going down. But what I've done is I've monetized, and now I think it's going to probably tag 290 or so. That's probably when I'll remove the short put. So getting a little cute there. I don't recommend that to the average spread trader out there. But I think look, this is a tradable environment. But I think the problem is this is a durable sort of theme, right? And it's going to take time for us to see how things unfold, and for a company like Salesforce to come out and say, hey, listen, nobody's leaving, nobody's giving up their 10,000, 20,000 a seat seats. They're very happy with what we're doing. We're moving towards AI. So there is time for these companies to adjust. But from a broader perspective, there's no question. This is the low-hanging fruit. This is ground zero for what AI can really do as a disruptible force.
Yeah, I agree. I think Adobe was a pretty clear disrupted, and so that trade, especially kind of in the context of the broader cloud sell-off, that kind of being the worst offender, I do think it makes sense to maybe say victory on some of that for now. IGV just looks so tempting if it gets down to $80. But to your point, maybe let it simmer, because if Alphabet bombs, then we could have some major problems correlation-wise, or if NVIDIA snaps below 170 any further, that's kind of when you might start to get some stuff hitting the fan.
Well, what I'm kind of monitoring, Oliver, is kind of this sort of sense that, and I talked about this in social media and in some of my newsletters. I said, I'm worried that there's sort of a general kind of malaise moving into tech. Now, we know the broadening trade. Everyone thinks the broadening trade is new, but it really has been underway for probably 7-8 months kind of thing.
Yeah.
And I think it's going to continue. And this is just one more piece of the puzzle that is going to potentially push more money into, your previous guests have talked about this, push more money into that broadening trade, which is sort of, we've gone from the low-hanging fruit in everything AI from an investor perspective to perhaps a little bit of low-hanging fruit in that, we're probably looking at a 10-year build-out cycle, industrial resurgence, and that's going to involve a lot of cool stuff. And real things that, the stuff you can drop on your toe, and, power grid stuff. And I mean, there's endless
XLB
stuff.
breaking out.
Exactly. And
buying XLB or one of these breakout moves like the DJI or something today, Hans? Do you think it's worth getting long some of these more pure industrial moves?
I think so. I mean, look,
breaking out.
Yeah, I think from a durability standpoint, I think absolutely you've got some. Now, have things gotten a little overextended? Perhaps. Now, I thought that about Staples. Staples had a big run. Now they're going to continue. Look at the Pepsi chart. I mean, it's going parabolic, like it's a quantum stock or something like that. Like they've hit on the, the next quantum computer. I mean, things are going a little bananas out there. So the flight to safety is starting to push quite aggressively into some of those areas where there's maybe a little bit of a dividend or the valuation. And we've talked about this. Money is shifting into where there's less uncertainty, and as a bonus you're kind of getting maybe a dividend in there as well. So it's much more comfortable being in some of these other places, and they have that, look at Corning. I mean, you're going to need glass for photonics, for everything. I mean, this is all part of the same sort of argument, and these are boring stocks that were ignored for a couple of decades, and they're back now. Boring is now beautiful.
Yeah, that's a pretty good one. I like that. Nice little jingle there for us. Boring is beautiful.
Boring is beautiful.
Stuff
but I think
when you drop it. Where's Clorox at right now? Yeah, there you go. 3% to 120.
I got all the sayings for you, Oliver. I make this stuff up. I'm not even
good ones in there. Yeah.
Yeah. I wake up in the middle of the night and I grab my pad and I go, oh man, Oliver's gonna love this one. So I write it down.
We appreciate that. Yeah. Well, one thing that's not boring is. ITA, we were talking about in the last block, which I thought was kind of interesting, because in terms of things connected to kind of the this industrial revolution or whatever we're in right now, this is one that I think is connected to that, but down today for the defense names, down 3%. But I would think this kind of fits to some extent some of the other industrial stuff that's going on. If you got a thought on that, Hans, go ahead. If not, I'll hear what you got.
Look, I think look, some of it is, okay, we're going to keep pushing into some of the things that we can drop on our toe. But we have had the space area has been, you have to sort of separate things into, well, what's going to happen, what's going to work right now, and what's a little bit moonshotty, what's a little bit more out there. So, in the space area, I know I kind of like Rocket Lab because launches are going to happen, this sort of stuff. But, you want to be careful. They're not all sort of painted with the same brush. And so some of those areas that did get a little bit overextended are pulling back a little, even if the underlying fundamentals, you're seeing some of the power names, nuclear, Cypher, iron, some of these areas where I'm quite sure that we're not going to have enough power and we need as many solutions as we can get. But those stocks are still suffering as the money is kind of panic moving into some of those very, very safe, Palmolives. Look at Walmart. I mean, everything's just going bananas on that sort of low vol side of things, which is not low vol anymore.
Yeah, no, that's a good point. By the way, great chart on Walmart over the past year. And to your point on I don't know, I wouldn't hate to buy the dip on nukes in UKZ. I'm a believer in the energy shortage as well. Good eyes and good catchphrases there, Hans Albrecht. Glad we got you. Thanks, man. Appreciate it, Hans.
Thanks, Oliver. Have a good day.
You got it. See you at Options with Hans. And we got Mr. Scotty Bauer on deck to take us into the bell. 3 minutes, 12 minutes to play. We'll be back in about 1.5. Getting Scott Bauer on deck. And market, by the way, is holding in. We're really trying to here. We're really trying to find some life. BRB. All right, we are back. We got the Mr. Scott Bauer joining us. Scotty, what's up? Looks like we might be trying to push here, make a little move. We're only down 15 right now in S&P.
There's again, we talked about this yesterday, Oliver, this kind of sense of we've been here and done this before. How many times are we going to see this same theme play out? Yesterday when you and I went on air, we were down 75 or something, and we rallied back to down 60. Today, this rally back in the last 45 minutes or so, almost getting us to break even on the day in the S&Ps anyway. The Dow is significantly higher. I don't know when that pattern is going to break, but the rotation that we've seen that I know you've talked about, it's significant. I think it's overdone. Personally, I told that to many of my followers, my students earlier in the day today. I think it's just way too overdone. But that's the environment we're in right now, that when we get a trade, when something hits the tape, when something is going one way, it's almost like it's parabolic, and when do you pull the plug or when do you jump in? That's a great question, but that's kind of the environment that we're in right now.
You think that was AMD today, the kind of catalyst to the early panic, if you will, on earnings, or was it?
I think it was a little AMD, and then that got accelerated during the day because there's some news that came out, which I don't think is verified, but there's some news that came out saying the nuclear talks with Iran are off the table or ending, and nothing in sight. So I think that added some some fuel to the fire. And then we had this midday turn. Google was up earlier and then took a nice big $10 reversal, $11 reversal midday, and that's right ahead of earnings, which tells me that people are getting really, really nervous about earnings. It's still down $6.50 or
Yeah, not much of a bid, somewhat, but not much for Alphabet.
Yeah, so I think people are just looking for some protection, and like we discussed yesterday, right? That flight to safety. Who knows what that is right now? We saw a sharp reversal in silver during the day, and it's not in bonds. Exactly, it's not in bonds.
Yeah. That was a key one that we talked about yesterday because ISM services looked good today, so no one really coming for treasuries at all. Before the macro thought, Scott, you guys got any strong view on Alphabet for earnings today?
I'm personally really bullish. I really am. I know the market is not forgiving right now. So unless these numbers, unless the AI commentary, unless the CapEx is just off the charts, maybe the stock doesn't react positively. I think it's ripe. It's ripe to blow out past those recent highs that we saw.
The relative strength has slowed down as it was making highs over the last couple quarters, but that hasn't stopped the stock. I mean, technically there's this kind of bearish divergence in it, but it's been the number one ranked AI, Gemini. And the chart, generally the price still has been a beauty up and to the right. The fact that it's pulled back the last couple of days, I would think if you're of the mindset that the kind of AI pullback is overblown, or that we got it out of our system with AMD, with slamming NVIDIA through 180 down to 170, then Alphabet's kind of your play. So, and maybe there's a way to hedge that, with broader index-based stuff, but I think for stock specific, I generally err on your side too, where it's probably worth a stab, just given how much I use the darn thing every day.
Yeah, I agree, and I think the big thing that we need to watch for is what's the CapEx going to be. Although that didn't really help Microsoft, Meta, because they increased their CapEx, pretty huge, and we saw the reactions there. I think Google's a different animal. We'll see. We'll see in about 10 minutes or so.
Yeah. The question of whether or not the market wants to see higher or lower CapEx is kind of a fun one. And so I'm going to plug it in. Why don't we do this? Let's plug it into Google. Okay?
That's great.
And see what it says. Because Danny was making the point, Danny Kirsch was saying, maybe the market won't like maybe it'll be the other way around. Maybe they won't like if they spend enough because they're
spend too much.
But so far, to your point, it's been generally, if the companies spend too much, then the market gets worried about it. Here's what Google's own AI says. Based on recent market trends and earnings report from Alphabet, the stock is more likely to drop if it reports capital expenditures higher than expectations, which aligns with your thought, right?
Okay. Well, let's see what happens there. I mean, that is going to be key in my opinion about direction for the stock. Long term, honestly, I don't care if they say that they're cutting back CapEx a little bit or expanding it a little bit. I think 3 months down the road, this stock will outperform. But obviously, we know the rationalization or not on commentary and on an earnings report, is very subject to other things than just looking at technicals or fundamentals.
By the way, maybe the trade. If tell me what you think about this logic, because here's the AI is basically iterating what you're saying, which is that it's important for their long-term growth to spend, obviously, but it could slow immediate returns or lead to margin pressure. They talk about Meta being the precedent, with Meta getting hit for that report.
And I didn't even look this up on AI before we just talked about it.
I know that's the logic, baby. So here's my idea. Okay, if the potential for downside on the earnings is that they're gonna spend too much on CapEx, but there's a strong narrative that the other stuff that's working in this market right now, materials, silver, and others, industrial trades, the stuff that's working today, if those are the beneficiaries of the CapEx, and maybe the trade from now to the end of the week is long Alphabet, and then long, your silver and your industrial in case they overspend. Maybe that's the idea.
It's very possible. Again, we're in this environment right now that pretty much like we saw for a good portion of last year, where trends are not necessarily, from what we've seen in the past, not necessarily the way to go, because anything can upend or catapult this market or an individual stock at any time. So I think it's a little bit more difficult right now. That might be what we're looking at, but I think that's a little bit more difficult when it comes down to stock specific, though. And I think it's really, really difficult to be a stock picker in this market right now. Google Alphabet is one that stands out to me.
I like that, and I think it's an important one because it was breaking out, it was outperforming for a significant period of time. And so then if it's going to remain a leader, that's going to be important to the market. The other stuff I wanted to hit you on, Scotty, we talked a little bit of bonds there, the data coming in strong, and we literally talked about that yesterday, but I feel like today, just worth pointing out again, that I think that still is a pretty high conviction view in my mind. It might force me to change my dollar view on the risk radar as well, because I've had the dollar red for about a week, and when it broke down.
Are you moving to orange now, or
well, if yields are going to blow out, then maybe the dollar sell-off is done. Maybe I was late to the party on that.
Yeah, it could be, but you know what? Let's wait till we get the real big numbers, which we're now going to get next week, JOLTS and the jobs numbers, which were delayed from this week, because that should really be a significant input into the bond market, to rates. It's going to bring the discussion up again. Are we healthy? The ADP number this morning was pretty paltry. I don't think that had anything to do, quite frankly, with this little sell-off that we saw today. But if that's the trend that we continue to see next week, if those January jobs numbers are really, really weak, you can see a rally in the bond market and rates come down a little bit.
If the numbers come in super, super light.
Yeah.
I respect that. I think that will be probably important. I think that the economic data is sort of taking a back seat, but is going to become more important now that we had two ISMs over 50, and now that it looks like we're going to get somebody to just cut rates.
First time in a long time we've seen that.
Exactly, and I do wonder if maybe that'll give our old, Bitcoin and crypto a life. I wonder if that really needs to go down to 60K to be done, or what your thoughts are there, Scott.
I don't know, like we talked about yesterday, Tom Lee and
Kathy Wood, we're all talking.
Thank you, Kathy. Thank you. They both said the bottom is in, and I think they're talking their book. So, it's real hard right now, because the entire narrative of crypto, Bitcoin, I think is just thrown out the window of what the use case is. So I think that one is really, really up for grabs. 60, is that a line in the sand? Maybe. Can we see all of a sudden, the sentiment just change and this thing trade 90 again? Maybe. But I think that many of the crypto bulls that have held on for a long time, that have just held on because the use case was there, that's part of what we've seen in these liquidations.
We're getting almost to oversold on BTC, by the way. Yeah. So maybe there's some hope there that in the short term, maybe that's a way to play a risk bounce back if the dollar drops, risk as a whole comes back. But it's just so convoluted with, I think, other things mixed in because of MicroStrategy. Frankly, I feel like it's just kind of in its own world as a risk asset. I'll give you the last thought. Scotty Bell just rang, and the S&P 500 did end down about 0.5% on the day, so we slipped back to a 35-point loss on the session.
Yeah, VIX never topped 20 today. Even on the low point of the market today, I think VIX was high 19s or so. That doesn't give me still a lot of conviction that the overall market or the institutional side is too concerned about a big downdraft in the market.
Okay. Yeah, I'm kind of in that same camp. This day could have been worse. It could have been better. But ultimately, we're so close, still to the highs and not far off them. Alphabet's big. Love the setup on that. Very helpful for us to think about Alphabet going into tomorrow, or tonight rather. I think that's probably
Yep.
the big move. I kind of want to just stick around and keep talking.
I know, I
until
do too. That's why I'm
comes
looking
out.
over here, and
Yeah, right.
I'm not sure if they're coming out right now.
Stretch
or
it
if they
for a
delay
minute. I don't
till
think anybody's ringing the bell here today. But
3:15.
yeah, we'll check in. That'll be the story tomorrow, I think, is how we respond to that. Thanks, Scott. You the man. Appreciate it very much, Scott Bauer.
Have a good one.
Good stuff. And a shout out to RB in the chat. Thanks for tuning in. Glad you found me again. Thanks everybody for watching Chicago Future of Finance. 3 p.m. I gotta go. Kind of want to keep covering the market, but we'll see it tomorrow, 2 p.m. Don't miss it. Have a great night.